Tyler, it looks like the charging stocks are starting to get a lot of attention again. You ready to have this conversation again?
Sometimes we do have to go back into the well and remind people of the quality of businesses really matters. And sometimes the quality of these businesses are a little wanting.
Reach our hand down in the well and help Timmy out of the well once
Yes,
again and say,
basically.
Timmy, don't fall in this well again, Timmy. All right. I'm sure some of you are watching this video and you're expecting a bullish take on EV charging stocks. Please watch this video. It's going to be valuable. If you want to get better as an investor, listen to people who might disagree with what you think. They might be wrong, but it will certainly help you figure out if you're right or not. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to fool.com/unscripted. Go to fool.com/unscripted. There's another 10 stock ideas for you. You can get access to The Motley Fool's 10 top stocks to buy right now. Go check out that link again, fool.com/unscripted. Okay, Tyler. So there's a couple that we're going to lead with here and that we're going to focus on to get a lot of attention, and that's EVGO, ticker EVGO, and ChargePoint, ticker CH.
Both more or less the same thing. I know there's some nuance related to the product that they actually do, their, market strategies, but if you just distill it down, they're both companies that manufacture a charging device, if you will, for charging electric vehicles, whether that be a kind of, we'll call it the snail mail version or the slower one and the DC fast charging ones. DC fast chargings tend to be the ones that you see in commercial locations like at your mall or places like that where you're trying to get a quick charge without the multiple hour overnight kind of charge option. The thesis on these businesses is that you deploy these, you sell a device at a relatively low to negative margin to get them deployed in the field, and then you sell subscriptions or basically a way of charging people for the use or convenience of these products. And that's the way over time. It is, on paper, it is a business thesis that has worked out in a lot of other places. The usage and service and maintenance and all that stuff becomes the high margin after the actual initial investment product. So that's like the investment thesis is basically we're going to deploy this massive charging network. And once it's all up, all the people using it or are going to be giving us money for the services that we provide, which, like I said, on paper, great. Execution
Yeah.
has not exactly turned out, I think, a lot of the way people had thought.
Yeah. And we'll talk about that some because let's be real. The past, year and a half, again, in North America, and that's where these companies focus, it hasn't been great for the EV industry. We've seen a big slowdown in demand to buy new EVs. We've seen the big automakers, the traditional automakers have pushed all of their EV capital projects a little bit further down. They're saying we're going to slow our build out. The demand seems like it's weak and it has been. So that's a factor that has come into play. But again, thinking about the long-term tailwinds, we're going to continue to see more electrification of transportation and more businesses, whether you own apartment buildings, you don't want to be managing, charging people for power or giving people access to power in your apartment complex, or you run a mall, same thing, right? These businesses, they focus on the thing that they're good at. So they should have a partner to manage the charging stations and deal with that with good software to be able to handle those things. So again, in theory, it certainly makes sense. And there's been revenue growth. So we look at ChargePoint over the past few years, revenue is still up about 80% from where it was back in early 2022. It's fallen more recently. We'll talk about that more. EVGO, I want to put on here, its revenue has skyrocketed at 828% revenue growth, and it continues to grow. But we're going to get into now, we're going to start talking about where the struggles have come into play and some of the challenges for these businesses that seem like they might prevent them from ever really being big winners.
Yeah, so it's a little bit strange. Like I said, it's supposed to be a razor and blade model where you grow your sales through selling the product. But what has happened is that for some of its subscription based, and I'm speaking more specifically about ChargePoint here right now, but you're actually starting to see some, I would call it not necessarily declining, but flatlining growth in its subscription side, which is supposed to be the profitable side of this business. And it's with a deceleration in kind of the station deployment, which is kind of a chicken and egg situation, right? If you're having fewer and fewer deployments of charging systems, that means the growth of your subscription business is going to slow down as well. it kind of it snowballs to a certain degree. What is also challenging, at least looking at this company from a financials basis, is that even though the subscription side of the business does look like it could be profitable, at least again on theory, that hasn't necessarily played out. If you look at its financials, it's a 20% gross margin business with subscription taking up a much larger portion of the overall revenue base, but its operational costs have just continued to plague this company in terms of being able to actually get something off the ground here. If you look at its SG&A costs or sales, general and administrative costs, they have not been like the fixed base costs that you can economically scale as your revenue grows. It hasn't quite translated yet. Now, I guess the argument could be that it is still early for this business. It's only been publicly traded for 5 years, maybe a little even less than that, 4 years. But financials going back to 2019, like, shows this trend playing out, and you're looking for some significant catalyst to change this, and it hasn't materialized yet.
No, that's right. So yeah, now a couple things. So ChargePoint, yeah, just went public in the past few years. It was founded in 2007. I want to say that this is a 17-year-old business. So it's only been public more recently. So the capital from going public it was expected to be part of how it would accelerate its growth. And I was sharing on the screen while you were talking some of those metrics. So again, gross margin, only 20%. Operating expenses have continued to increase even as revenue has started to decline more recently, and operating cash flow has never been positive in its existence as a public company, continues to burn cash. Here's the thing, I want to stress this too. We're not dunking on this company because we think it's a terrible company. We're laying out the facts to make it clear the real struggles the company is going to be continuing to face that should be concerning for investors, right? You can love a company, you can love what they stand for, you can love what they're trying to do as much as you want to. That doesn't make it worth investing in. And the concern here is that the financials are deteriorating. The cash flows are negative. I'm going to share this slide again. When we were talking about it, you were talking about kind of the mix of numbers. And I want to really highlight this because again, yeah, so that subscription revenue, we've seen some growth and that's good, but it's mostly been steady. It grew a little bit in the most recently reported quarter, but the blue one is the one that I really want to stress. This is deployments of sales of charging systems. They've been consistently, and we saw it in the revenue line that I showed on that chart. The revenue is in decline. If this is a growth business and the revenue is in decline, but their operating costs are continuing to go up and they're burning cash at an increasingly high rate, investors should be very, very concerned and not be so ready to rush invest in a company like ChargePoint. I want to talk
I
about, go ahead.
I was just gonna add too, and this is the case for both EVgo and ChargePoint. If you look at their balance sheets too, you'll notice that, basically the amount of cash that they have burned over the past 12 months, both companies respectively, it's more or less equivalent to the amount of cash that they have on the balance sheet, which basically means if things continue the way they're going, these are both companies that are gonna have to make significant capital raises to do that, which probably, based on their financials, is going to be a issuance of shares. And if you own these companies, you don't necessarily want the issuance of shares because it's going to dilute you in the future.
Yeah, particularly with the share prices where they are right now, so low, it's going to take a lot more shares to generate the cash that these companies are going to need to add to their balance sheet at their current levels of cash burn. That is a real direct risk to you. So just remember that, individual investors, when you're looking at these companies. I want to share that same chart that we talked about. I want to share that same chart that we did for ChargePoint for EVGO. Again, operating expenses have continued to rise. They've started to stabilize over the past year, but operating cash flow, again, also improved, but substantial consistent level of cash flow burn. The company only recently got its margins. Again, this is gross margins. Only recently got its gross margins from positive to negative. So put all that, or excuse me, only recently moved its gross margins from negative to positive. It's good that they're positive now, but they're very, very, very thin. Even as it's increased its sales of services, that recurring revenue, its margins are still extremely thin. So investors should really step lightly into these sorts of businesses. Again, love the idea. The tailwinds are there, and there's a difference between tailwinds that can make an industry larger, because I promise 10 years from now, we're going to look back and there's going to be a heck of a lot more EV chargers deployed, whether it's the fast charging stations, whether it's publicly accessible charging stations at places like malls and apartment complexes and places like that. We're just going to see a lot more of them out there. What's less obvious for these pure play companies, Tyler, is whether there's enough economic opportunity for those businesses to build as standalone businesses, profitable niches that can create value for shareholders, especially when they're competing against companies that have large ecosystems that are also participating in this space, that have other ways that they make a lot of their profit that aren't necessarily pushed into the same corners as EVGO and ChargePoint are to make a living. Tesla is the behemoth. We're seeing more and more automakers sign up to the Tesla plug standard. That is an added cost for a company like EVgo or ChargePoint to expect that customers are going to buy plug adapters to use their stations. We're seeing Tesla continue to, they've slowed it a little bit, but they continue to add more of their supercharger networks out there. That's a big competitive threat to these companies in the fast charging space. We see companies like Enphase and SolarEdge for residential chargers. Eventually, we could see them move into the commercial space for apartment complexes and places like that as well. Those are companies that have ecosystems of other products and services that they sell that this just fits within. So you put all of those things together, and whether it's because the stocks look cheap and you think the long-term tailwinds are good, I just don't think investors should be taking the risk of investing in EVgo or ChargePoint right now when there are far better options out there.